Now, enough from me. Let's move on. As we've already introduced to these guys, let me just quickly bring Julien up. Come on up and let's hear about your presentation, all about what Coface is thinking about risks today. Come on in. Thank you.
So let's start with a question. I guess you forget it?
Oh, did I? Oh.
Yeah? You want to do it or I do it?
No, you go ahead.
Okay. So, how does it work? You know?
No.
Okay. Starts well. So you have, yeah, you go to the website on the top, and you have to answer to this question. So if Coface was to hold the country's meeting in a different city, which would you prefer? It's quite balanced. So it looks like a lot of people want some sun. Yeah? Okay. Okay. Sounds good. Some sun or some fun with Las Vegas? Okay, we're done? Yeah? So good news for me. It looks like next year I'm going to visit Orlando. I've never been there, so thank you. Thank you. So thanks for your vote. Thanks for being here. As Frederick told you, it's this country's conference is a kind of a well-established event. The first time I participated in this one in New York, I remember it was in the midst of the global crisis, and in the end of my presentation, then I realized I was very depressing because there are a lot of countries in recession and so on. So it was feeling like I was kind of an undertaker. This year, my job is going to be definitely much easier, I hope. And this is a key message of my presentation. The global outlook is definitely pretty good in terms of growth, in terms of business insolvencies, which matter for us as a credit insurer, as you know. Having said this, let's say the key message number 2 is that according to plenty of indicators, the peak has been passed in a lot of countries. And the third message is, okay, the global outlook is pretty good, but let's say the car drives quite fast, but the road is still quite bumpy. And businesses still have to face with plenty of risks, especially at political level all around the world. So I think these are the key messages of my presentation. So let's start with the good news. As I told you, as a credit insurer, we like looking at business insolvencies. And here you see what happened last year and what do we expect for this year for a large number of advanced economies, 20 to be specific. So what do you see on this chart? I mean, the picture is quite crystal clear. Last year, in most countries, business insolvencies decreased quite a lot. On the left of the chart, you see quite a lot of, let's say, small open economies that benefited a lot from the pickup in global trade last year, especially in Europe. But even in the middle, I mean, you realize, the bulk of large domestic demand-driven economies, including the US, Germany, France, and so on, also recorded a quite significant decline in terms of business insolvencies last year. And on the right of the chart, you see some exceptions with countries like the UK. You will not be surprised, where business insolvencies have increased quite a little bit last year. So now what do we expect for this year? Quite the same trend, but the key idea is that the movement is drying up a little bit. Why? Because in 14 out of 20 of the countries you see on this chart, now business insolvencies are even lower than they used to be before the crisis, which was an all-time low. So it means that the room for improvement is not very significant right now. And in other words, it means the peak of, let's say, the peak of growth has been passed. And by the way, this is reflected in business confidence indicators all around the world. And you see on the left the US. I won't say more about this because Thomas will detail it later. On the right, you see the same type of indicator in the Eurozone. I could have added Asia, it would have been the same. I mean, all in all, I mean, in terms of level, businesses remain confident, but they are not as confident as they used to be last year. And at first glance, I mean, it's quite puzzling, because I was telling you, I mean, business insolvencies keep decreasing, meaning that the financial situation of businesses remains quite good all around the world. So the question is why? Why do we see, since the starting of the year, this, let's say, this turning point in terms of businesses? I'm asking you the question. So let's go back to your phone. According to you, why do you think businesses are less confident globally since the starting of the year? Remember, you have to read until the end. It looks like nobody read the last ones. Okay, we're done. Trade protectionism. Thank you. It's a good news because my next slide is on protectionism. So, indeed, I mean, since the starting of the year, we're talking a lot about trade protectionism. And a good way to look at it is that if we look, I was talking about business confidence, but if we look at the detail of business confidence indicators, what businesses tell us all around the world, this is the same story. We are quite confident at home. We are still confident that the domestic situation is quite good, but we are quite worried about what's going on externally. And by the way, if you aggregate all of this all around the world, it doesn't make sense. But it's a good indicator that the situation is more and more worrying for businesses when they think about export. Another very simple way to look at it is this chart, which reflects the use of the word protectionism in Google search. So you see it increased a lot right after the global crisis, which is not very surprising. I mean, in recession times, we talk a lot about protectionism. And then it increased again from late 16. So at first glance, you can say this is surprising because we were not in recession times anymore. But of course, it's related to what happened in the US with the election of Donald Trump. So now, having said this, the question is, okay, we talk a lot about protectionism. It seems like a lot of people, a lot of businesses are more and more worried about it. But in real, can we say protectionism has increased or not? So to answer this question, we have looked at Global Trade Alert data. Global Trade Alert is a private non-profit organization which lists all measures globally in all countries, in all sectors that constrains trade, external trade, and on the other side, all measures that aim at liberalizing trade. So what we have done is we have calculated the difference between the two, and you get this index of protectionism. So what do you see? Since 2014, at global level, as a paradox is protectionism has decreased and has not increased. And it's not surprising, as I was telling you, it's related to the better economic situation. When growth recovers, governments tend to be less protectionist. Having said this, when you look at it more into detail and you make the breakdown between the US and the rest of the world, you realize since last year, and this is not surprising, there have been more protectionist measures in the US. But it has been more than offset by a much lower number of protectionist measures coming from the rest of the world. Why? And that's a paradox, because we have seen when finally the US and Donald Trump talk about protectionism and threatens some countries about some protectionist measures, it looks like those countries try to offset it by negotiating some free trade agreements with other countries. Let's look at Mexico. Last year, they decided to negotiate some free trade measures with Brazil and Argentina regarding some agricultural products because they were afraid that they could not rely anymore on the US regarding this type of products. Mexico tries to deepen its free trade agreement with the European Union. The European Union has signed a free trade agreement with Japan because both were worried about what's going on with the US. So all in all, the paradox is that sometimes when we talk about protectionism, it can lead not necessarily to more protectionism, but also to more free trade agreements. So, having said this, it doesn't mean it's not an issue for businesses. When some countries decide more protectionist measures, and obviously this is the case for the US, it is having an impact on businesses. But at global level, at this stage, we can't say this is a big increase in protectionism. So in this environment, you see on the left our global trade forecast, which is based on a very simple statistical model, including as an explanatory variable business confidence in the US, oil prices, a global index for transportation prices, the Baltic index, and Korean exports, because we're used to say Korean exports is a good proxy for global trade. And when we take into account all of this, it's a good summary of what's happening right now. I mean, it's still a quite decent forecast for this year. Admittedly, we're still far away from global trade growth we were used to see before the crisis, but it's definitely much better than it used to be in 2016, for example. And by the way, when you look at other dimensions of globalizations, not only trade, like financial flows on the right, it's the same conclusion. You can't say globalization has stopped. Financial flows have recovered almost their pre-crisis level last year. I could have added migration, I could have added information transfers and so on. It would have been exactly the same. So all in all, despite all this noise, despite all this communication, companies continue to trade, continue to invest abroad. And the key rationale behind this is very simple, is that if you think about it, I mean, the key drivers behind global trade are still at play. For example, why do a company based in a developing economy export to an advanced one? For a very simple reason, it's labor cost. I mean, when China decided to enter the WTO and other Asian countries gained a lot of market shares globally since the starting of the 2000s, it was because of labor cost. And it's still at play. Look at this chart. This is GDP per capita for a large range of emerging market economies as a percentage of the US. So let's look at China in the middle, for example. Okay, 15 years, I mean, in 2000, GDP per capita in China was only 6% of the US one. So there have been some catch-up, but even now it's only 25%. So if there is a tariff of, let's say, 25%, does it mean that you're going to stop exporting from China to the US, given this very big gap in terms of labor cost? No. And now if you look at it the other way, why do a company based in the US, for example, export to China to penetrate a fast-rising and large consumer market? And in this regard, according to very recent works, I mean, the middle class in China is expected to reach 1 billion people 10 years from now, and to double. So it means the same. I mean, if today, and this is what's happening, I mean, there is an increase in tariffs, it doesn't mean businesses will stop exporting to China, because they will continue to want to be present in this fast-rising market. So all in all, what does that mean for you as a business? I mean, 10 years ago, a lot of people were saying, okay, multinational companies, now we can forget borders. They are very powerful, and we have to think global. We don't have to pay attention for borders and so on. That's not true anymore, obviously. And for example, you saw yesterday a large electronic company in China said it has to stop production because of a decision taken by the US government. So it means multinational company can be impacted by government measures. And sometimes for large multinational companies and all exporting companies, it's even more important than what's going on with your competitors. But having said this, it doesn't mean globalization stops. So in other words, it means that even more than before, you have to be aware of country differences, you have to be aware of borders, and you have to be aware of country risks. So, you know, some of you may know at Coface we used to do that. We provide country risk assessment for 160 countries all around the world. So it's an 8-grade scale based from A1 to E. So A1 in green, this is the best risk. And then, of course, in red, this is the highest risk. So over the past 2 years, of course, we have decided much more upgrades than downgrades because the economic outlook was improving. Last time, it was more balanced for the first time in 2 years, meaning that the peak, again, another sign that the peak of growth globally has been achieved. And regarding emerging markets, as I told you, because of higher global growth, higher oil prices, we have upgraded quite a large number of countries over the past 2 years. Having said this, you also see on the map that a lot of them are still in, let's say, red or orange, meaning that the level of risk remains quite high in a lot of regions. And why? Because we still think there are still plenty of risk to monitor regarding emerging markets. I mean, the first one is related to the US Federal Reserve. You have seen it in the news over the past days with what's happening in Argentina, what's happening in Turkey, and so on. Over the past years, emerging markets have relied too much on global liquidity provided by very expansionary monetary policies, especially coming from the US Federal Reserve. On the right part, you see the outcome of a work done by the IMF. And so the IMF has calculated the share of flows going to emerging markets, which is driven by the US monetary policy. And what's the key message on this chart on the right is if you combine both bars in blue for 2017, it's more than 3/4 of flows going to emerging markets which are driven by the US monetary policy. In other words, it means that if the US monetary policy tightens faster than expected, all these flows will go back to the US. So in this regard, what countries are more at risk? You see them on the left. There are countries which are reliant on external financing. And you're reliant on external financing if you have a current account deficit or if you have some debt to roll over in the coming months or in the coming years. And so countries which are on the top of the chart of the left are definitely riskier than the other ones in this regard. And the level of risk is even higher when this situation is combined with a high level of political risk, of course. And again, Turkey is a good example. So over the past 2 years, we have spent quite some time to review the way we measure political risk in emerging markets, because obviously we know this can have a very big impact on businesses. If there are uncertainties at political level, businesses will stop investing. If there are an unexpected change at government level, we know businesses can be stopped in their production process. So there can be a lot of different ways businesses are affected by political changes. So a lot of changes have happened, of course, over the past 5 to 6 years in emerging markets, the Arab Springs, Brazil, Turkey, and so on. In all cases, there are some common points. I mean, in all cases, there have been 2 drivers behind these changes. The first one, obviously, is social frustration, because when a population is frustrated, of course, it can lead to some political changes. So to measure this social frustration, we have taken into account all indicators you see in red in the bottom of the chart, which is inflation, income inequalities, the purchasing power, the level of corruption, and so on. Then one of the learning of the Arab Spring is that in some cases, social frustration doesn't reflect into effective political change because the population doesn't have any tool to express this frustration. And by tool, we mean access to the internet, the level of urbanization, education, and so on. So all indicators in green in the bottom of the chart. And when you combine both, you get the top 30 countries in the world where, according to us, according to this matrix, political risk is the highest. So let's forget the 4 to 5 countries on the left which are in war. So anyway, of course, political risk is very high there. But then you will not be surprised to see quite a large number of countries in the Middle East. And by the way, you see Iran, which is quite well positioned, meaning that if, because of what has been decided a few days ago in Washington, the currency in Iran depreciates further, it means inflation will increase even further, and this index is likely to rise even further in the coming weeks and months. You also see quite a large number of Latin American countries, all the more since there are going to be some, as you know, some tricky elections in some key countries in the Latin American region this year, starting with Colombia next week, and then, of course, Mexico and Brazil later this year. So just a few words on Latin America. Just to make it short, we think that Latin America this year is going to face the same old challenges the region has had to face over the past 20 years. The first one is bad politics, because, of course, if there are some unexpected changes at political level, it can lead to depreciation of currencies, and it can lead to a vicious cycle for those countries. All the more since, of course, the second risk is related to what I said, all the more since if for some countries there are some issues regarding external financing. And the third one is the reliance, the dependency on commodity prices. This year, it looks like it's a positive news for the region because oil prices and all other commodity prices are going up. But when you combine all of this, you get this, let's say, pretty mixed picture, which is reflected in our sector risk assessment. So I showed you our country risk map. So this is our way to look at the credit risk for corporates on a country-by-country basis. We also look at it on a sector-by-sector basis. To do that, of course, we take into account our payment experience. We also take into account the qualitative view of our credit analysts, our underwriters all around the world. And we also take into account financial data of all listed companies all around the world. And when we combine all of this, you get this 4-grade scale from green, which is a low risk, to red, which is a very high risk. And so all in all, as I told you, the picture is pretty mixed. Of course, energy sectors, the outlook is improving because of higher prices on this side. But on the other side, we are more cautious on some sectors like construction, for example, because if this year currencies continue to depreciate, sectors that will suffer the most are the ones that import a lot of inputs without exporting their output. And construction is definitely the first one in this regard. So risk number 1 for emerging markets, external financing and the Federal Reserve. Risk number 2, political risk. And risk number 3, it's not a surprise, China. Because as you know, I mean, a lot of regions, a lot of emerging markets are still very reliant on China, in Latin America, in Africa, in Asia, obviously, because they trade a lot with China, but also because they rely on commodity prices, and China has a big impact on commodity prices. China still accounts for more than 40%, for example, of steel demand globally, more than 10% of oil global demand. So the key challenge for China is pretty simple, is how to deal with population aging. It means that for the rulers, they know that in the next 10 to 15 years, they will have to move up the value chain very fast. They will have to forget old sectors that rely too much on labor force, like, for example, textile clothing, and they will have to rely more to develop more innovative sectors. So to do that, of course, China's economy has to find a way to innovate, but to do it very fast. That's why that's why China's authorities do their best to convince or to force foreign investors to invest in research and development in the country. And by the way, that's why there are some tensions with the US and with Europe in this regard. And to do that, businesses invest a lot and get a lot of debt, a lot of financing to invest a lot. The problem is that we have been too far on this side, and corporate debt has not stopped increasing, and it keeps increasing. And so that's a problem. That's a problem because corporate debt is now very high. And another way to look at it is on the right-hand chart of the slide. On a yearly basis, Coface makes a survey. It asks a number of questions to about 1,000 businesses in China. And what you see on the right is that in 2017, 47% of surveyed businesses were saying very long payment delays, so longer than 6 months, accounted for more than 2% of their turnover. Now, if you focus only on the deep blue part, 21% of them were saying these ultra-long payment delays accounted for more than 10% of their turnover, meaning that more and more companies are facing payment delays, and of course, this is an issue from a credit insurance standpoint. In the meantime, of course, the rulers are worried about this situation. They're very stressed, and so the political control is even tighter. You've seen what happened. Xi Jinping has been re-elected for a second mandate. The day after, he has changed the constitution, and nobody dared to oppose to this vote. For the first time in history, you see it on the left. What does that mean? A lot of people were saying it's not a big change because China was not a democracy before. It's obviously not a democracy right now. For me, it is a big change because before, China was ruled by a party, meaning that if you're a Chinese people and you want to work for your country, at least you could expect to be part of the party and then having an impact on the economic policy and having an impact on the country. Now China is not ruled by a party anymore, it's ruled by a man, meaning that it can lead to some social frustration even more in the years to come. And when you combine all of this, it means that when China knows an economic crisis because of a too high corporate debt, there is a good chance there is a political crisis as well. So this is something, of course, to have in mind. Last but not least, let me say just very briefly a few words on Europe. As I said at the beginning, the global picture, the picture for Europe, for Western Europe economies is pretty good. Business insolvencies are declining still quite fast. Unemployment is also declining. This is a big change compared to 2 years ago when I was here, when I was still talking about higher unemployment and so on. Having said this, even if the macro picture is pretty good, as a credit insurer, we still see some risks at micro level. A good way to look at it is this chart. We have tried to measure the share of, let's say, zombie companies in Europe. What do we mean by zombie companies? Zombie companies, this is something which was launched in Japan 20 years ago. At that time, people were very worried about over-indebted and non-profitable companies which were supported by very loose monetary policies. So it means that there were, at that time, too many companies that were insolvent and too highly indebted to invest, and that was the starting point of the stagnation in Japan. When we look at the situation in Western Europe, we still see there are some quite a significant part of companies in France, Germany, Spain, and Italy which are facing the same type of problem. So again, it doesn't mean the situation is not bad, but of course, it means even if the situation is pretty good at macro level, at micro one, we can see some problems. And last but not least, businesses in Europe are now facing very different problems than they used to face a couple of years ago. So a couple of years ago, most businesses were saying they were complaining about insufficient demand. Now you see on this chart, according to the European Commission, a lot of businesses now are saying They don't complain anymore about demand, but they're more complaining about labor shortages and a lack of equipment. This is not surprising in countries like Germany because unemployment there is very low, a 25-year low. It's the same, by the way, in Japan. It's the same in the US. It's more surprising in other countries like France, for example, because unemployment is still quite high there. But despite this, businesses, that's the paradox, face more and more labor shortages. Why? Because we have too many people that have been jobless for a long period of time. So now, even if the recovery is there, businesses don't want to hire them because they're not qualified enough to work. And so, of course, this creates a lot of social frustration in some European countries. And that's why tomorrow, Italy could announce we have a government between a far-right party and with a far-right party and a far-left one. So all in all, what's going on in Western Europe, it's a pretty good summary of what's going on at global level. I mean, from a macro standpoint, the picture is quite rosy. But second point, of course, the peak has been passed. And third point, there are still a lot of political risk to be monitored by businesses. I stop here, and I thank you for your attention. Thank you.
Well, thank you, Julien. I mean, you're speaking my language. You could be a journalist if you ever want to be. I mean, just looking through what you said, I mean, delinquencies, it's so good it can only get worse. You could have taken that from one of my articles about bank delinquencies. Fantastic. You've given me so much fodder that we can try and sell back to you guys. I love it. A couple of other things that I liked. Actually, I know I said at the beginning there's some echoes in the way we're working from the last crisis. Actually, your comment about how much money has gone into emerging markets reminds me very much of the one 20 years ago, which was when I was starting as a journalist, where everyone was saying to me in 96, 97, we're investors, we get what we're doing. Europeans in high yield, we totally understand that now. Emerging markets, not a problem. A year later, they're all pulling out and wetting their pants and going into US treasuries. So again, I'm not saying that's what's going to happen. Maybe that is what's going to happen. But I do like the corollary here, and it sort of fits into my general theme of trying to find doom and gloom, although not from Breitbart. Let's just be clear about that. And the one more thing I'd add, just when you're talking about exports and trade, the one thing which I don't think we should forget is, on the flip side, in the US at least, there's also an import issue. So when it comes to what the Trump administration is proposing, and again, I go back to my thoughts about car companies that I cover, they're very concerned about what the Trump administration's policies mean for how they import goods to make their cars, or even import goods that are already in goods that they've made, and also what that means for their supply chains around the world, which isn't quite the same thing, but actually also has a bit of an impact, if not quite a big impact on everything else. In fact, in general on trade, again, I'm bringing this up largely because it's autos, it's trade related, but it is also climate risk, despite me saying I wouldn't. This morning on Ford's AGM, one of the questions was about cobalt risk. Where are you getting your cobalt from? Is it sustainable? Are you getting it environmentally sustainable? Are you getting it without risking human rights violations? And you think about how important cobalt is, one single element is in electric batteries, and how most of it is coming from the Democratic Republic of Congo, and how the entire idea that car companies around the world have about how transportation is going to change over the next few years, and cobalt, and where it's from, how it's mined, who's doing it, and how to trade it, and how to get hold of it, is one of the single biggest factors that will limit how quickly electric batteries and the autonomous revolution will take off. A bit off the country risk topic, but actually also somewhat of a trade topic that we've been at Reuters focusing on for about a year or so.